let's also get our experts in on what they're tracking as well. Rajesh, in terms of the trend you're observing, and if not on the index, where are you seeing action today? Would it be on the Bank Nifty? Would it be on the mid cap index? Where are you, concentrating?
Yeah, good afternoon. If you look at the overall the setup of the market, indices is consolidating in narrow range of 11,850 to 11,900. This is the range which we have seen since morning, and we believe that this consolidation is likely to continue for some more time. And once again, if indices manages to cross above 11,940 level, then again this upward trend will likely to continue, and then we may see further higher level from the current level. So as of now, we see that 11,850 is the immediate support level for the Nifty. So any minor dip is is a opportunity to buy the stocks at the lower side. But if we look at the other side of the market, we have seen a lot of momentum in the stocks where we have seen good results, or earnings are showing positive tick. So those stocks are showing buying interest throughout the session, and on the mid cap front also we have seen quality mid cap stocks are also showing some sort of buying interest. So the one should remain on the stock specific where the breakouts are already there on the near term chart. One can keep on buying on those stocks, and momentum is likely to continue on the bullish side. So our stance is on the bullish side. One should use any dip as a buying opportunity in the current juncture.
Okay. So really buy calls all around there. Rajesh, let's talk about some of the stocks that we are looking at today that seem to be on a roll. Amaraja on earnings, for instance. We've got a whole host of other names. Motherson's also been seeing a lot of activity of late. Even today I see that it's up another 4%, as is in HDFC AMC. That's another one that we've been seeing strong gains in of late. Any of these or anything else that you're looking at?
So HDFC AMC is looking very attractive. Even if you look at the higher side also, stock is enjoying at the all-time high level, but still the buying interest is there in the stock. So our recommendation is on the to buy the HDFC AMC at the current level also, and we feel that stock can rally towards 3,400 to 3,450 from the current level also. So any minor dip is a buying opportunity. One can keep stop loss of 3,270 for their long position, and we are expecting 3,400 to 3,450 target in the near term. On the other side, Yes Bank is on looking very attractive at the current level also. Again, stock is managed to cross 72 level, which was very critical level on the higher side for the Yes Bank, and in the today's trade, stock managed to cross this 72 level on the higher side. So if it continues to trade above 72 level, then again Yes Bank is looking again attractive from the current level. One can keep very strict stop loss of 70 at the current level for upside target of 76 to 78 on the Yes Bank also.
Okay, stay with us. Lots more to talk about, lots of stocks to assess technically, but with stocks near record highs, investors are again getting wary of chasing prices. Quality always trades at a premium, but does it really offer comfort of safety and best growth, or is there a case for value hunting in mid-caps? We caught up with a number of experts on their assessment of the situation.
I think it is not fair to take a point-to-point return and say that from the lows stocks have moved up this much, but it has been to some extent a beta trade also, particularly over the last 2-3 weeks, and investors who had sort of not been invested suddenly started to see the merits in investing, and they just jumped into companies which had fallen a lot. So I think selectively I would say in some companies it's been more than warranted the price rise, and we have to be careful. But in a lot of other companies the prices had fallen disproportionate low compared to their valuation, and I think that is some place where we still continue to be quite optimistic on.
Quality is almost always expensive. The only times you will not find it being expensive is in crises and recessions. You pay for what you get. They are expensive because they're well run, because they have a history of treating minorities with respect, because you can be assured every year there will be perhaps not the strongest growth, but good solid growth. So that kind of portfolio, I think, should always form the basis, the core. Growth has been on a huge tear globally, and I would say that's largely a function of low interest rates. And the lower interest rates are, the more capital there is just flowing around the world that is seeking out returns and willing to finance riskier things, which growth companies usually are. Holding a bit of both is the way to go, because quality is safe and steady, probably should be the bedrock of one's portfolio, but supplementing it with growth in this kind of environment, where interest rates are going to stay long for the foreseeable future, is not a bad thing to do.
Okay, we've been tracking CLSA's commentary today. They're expecting a powered up economy in a few years on the back of government reforms. Ajay is going to take us through that note from Mahesh Nandurkar. Ajay?
Well, that's correct. One of the most detailed note coming in from CLSA regarding the economy, clearly making a case that the Indian economy is powered up to grow very significantly in the coming years. It will take a couple of years because there have been some structural reforms which have been taken. It may not start showing immediately, but in next coming quarters onwards, there will be a gradual recovery which will come in, which will reboot the economy overall. They say that one of the biggest things is that we are becoming a high inflation economy to a moderate inflation economy. That will actually drive the rates lower. We've already seen some amount of rate fall happening, and perhaps there's scope for much more going ahead, though there is gap between the real rates and the RBI's repo rates, but still they believe this will happen. The insolvency board, the way NPAs have been cleaned up, this is really helping the financial sector a whole lot, and earnings will start growing on the back of financials having the largest weight in the market. They are not ruling out return of double-digit earnings growth rate as well in the next few quarters because of the massive game changer of a tax rate cut which has happened according to them. They say that the housing market is close to bottoming out with the recent boost coming in for the housing sector. This has got the largest multiplier effect as far as the overall economy is concerned, and it will start showing very shortly the way almost 25-30,000 crore which has been released will impact upward anywhere between 50 to 1 lakh crore to releasing of liquidity in the real system. So that's a sense of the note coming in. Remember, just a couple of days later, CLS is also holding their India conference. So this is the gist which they are planning to drive to over 100 institutional investors which will be congregating in Delhi for this India conference.
Green shoots visible according to the House of CLSA India. We're going to take a very quick break. Still pretty soft on the headline index, and market breadth is still even Steven. Take a quick break. When we come back, lots more market experts joining on the show.
Welcome back. Let's get some trading strategies going. Rajesh, let's start off with you then. And, there's plenty to choose from in today's market. We've been talking about some key stocks. What are some of the strategies you recommend?
Well, I would be looking at, Motherson Sumi. That stock is set to come out with some results today. But the price action seems to be quite positive. Since that is so, I would think there is a certain expectation of positivity from the numbers, and we can look for a price target which should be around 144 levels or so. I would initiate a long position with a stop at about 128. The second stock that I would want to also be a buyer in would be Z. Now, Z has been faring very well in recent times, and today there is a clear revival in the demand, and the stock is trading pretty well since the open. 302 current levels can be a buyer here with a nearby stop at 297, targeting about 315.
All right. Rajesh, what about you?
Yeah, first stock from my side would be ICICI Bank from banking space. If you look at the structure of ICICI Bank, its stock is trading above all its important moving average, and looking at the consistent buying even at the higher level, we feel that stock can further rally from the current level. Even on the derivative side, the long addition has been witnessed of around 5% open interest addition has been seen in the throughout the session. So I feel that 505 would be the target in the near term basis for ICICI Bank. One can keep stop loss of 485. Another stock is to buy from the current level is Fortis Healthcare. If you look at the structure of Fortis, stock has managed to give breakout on the daily as well as on the weekly chart after long consolidation. And looking at the structure, I feel that stock can continue further up move from the current level, and we expect that the 167 could be the target in the near term basis for the Fortis Healthcare. One can keep stop loss of 154.
Okay, those are some technical ideas coming in, but here's a programming note. Our new series, ET Now Time Machine, the Lal Street veterans shared their, or rather what they had, they do differently if they could be younger again. Market experts take a journey back in time to share what stocks they missed out on when they were younger. So take a step back in time with ET Now.
I remember one stock which I got into was Mastec, and the market went higher, and again it sort of failed and fell. And in those days we used to have circuits, as a system. So Mastec actually triggered the stop loss, and I should have sold. It was very saleable on the screen. However, you get into a bit of arrogance. You get into this complacency or this feeling of, as I said, master of the universe. And I really didn't honor my stop losses or didn't really exit where I had to exit. So this really was very, very painful, because after that, the stock went into continuous circuits. Circuits means that the stock would fall 16% a day and there would be no buyer. So what really happened was that here was a stock which I should have exited. It was available as an exit on the screen. There was liquidity. However, my failure to not trigger it on day X, but on day X plus 1, the stock went into downside circuits. And I remember losing 60% of the value of a stock before I could finally sell it. And when I look back and I see the hit I took on my overall returns, so in the largest scheme of things, I exited very well. However, it is one mistake or one complacency or one lack of discipline to be able to make your exits when you have to be. So it has to do with discipline in exiting. We all are very, very obsessed with what to buy, but ultimately it is when you sell that makes a very big difference. And inability to sell, whether you are in profits or in losses, actually makes you or sets you back by a long, long way.
Okay, Nitin Raheja also joining us on the show today. Nitin, good afternoon. Markets seem to be holding fort at those higher levels. It seems to be all about specific stocks, over the last couple of sessions. Within broader markets, then, what are you tracking? What's been standing out to you? Have you been looking at earnings on specific names? Any themes that are standing out?
Well, I mean, clearly this is a bottom-up based market, because there are a couple of factors holding. So you have these so-called quality names, as people say, and people are ready to pay any sort of premium for those names. So either you have one strategy where you're sitting there, but I think beyond a particular level, you find it hard to justify to yourself in terms of putting more money to work in stocks at any prices. Because we've seen these kind of markets even earlier before, when markets do change and these stocks then don't perform for a very long time. So I think this is a bottom-up market here. Because for example, if you take let's take the CNX 500, right? And I'm not going to talk about profit growth at this time, because profit growth has got aberrated by the tax cuts. But if you take the overall numbers, sales have grown 5% for about 352 companies that have declared numbers, and operating profit has grown about 11%. Now, that's not great, but if you come down granular and you start looking at it from a bottom-up perspective, there are plenty of opportunities that have been thrown up. For example, you take a lot of the services-oriented businesses. Say you take gas companies, they've declared good numbers. You take on the entertainment side, the exhibition companies, they've declared great numbers. You take some of the private banks, they've shown good numbers. Hospital companies have shown good numbers. So I think you've had to pick and choose, and I think where you've been able to call the sector themes right, I think you've seen portfolios starting to outperform the index in the last couple of months. And I think that's broadly the direction that will even continue going ahead.
Right. Nitin, I don't know if you caught Atul Suri and, we took him back in time. We're launching this new series called The Time Machine, wherein some of the veterans of the Lal Street tell us about if they were to go back in time, in the 18-hour time machine, what is it that they would tell the younger self or do differently, and one of the biggest mistakes or regrets that they've had. For Atul Suri, it was not selling Mastic at the same time, and he said that the biggest learning that he's had in his investing and trading journey has been not just when to buy, but when to sell. What has it been for you, Nitin, the biggest learning?
So I think very coincidentally, we were also tracking ourselves and trying to understand what we learned from the market in the last couple of years. And we've seen that in the past. I think one of the biggest things is not taking your profits. Now again, that could also mean that at times you get you could probably lose into some of your big winners, and so on and so forth. So I think we've been really looking at that aspect in terms of how do we protect profits, because I think even if I look at our own portfolios in the last couple of years, we're sitting on humongous profits in a number of mid-cap names. I think, one of the big learnings that we kind of looked and derived was that one is, of course, we didn't adhere to stop losses in certain cases, but more importantly, I think when a stock started correcting from the top, we didn't keep a sort of a loss. And there's no accurate method, but one of the methods that we found is that where we found a number of our stocks starting to breach the 200 DMA and flirt with it at least 3 to 4 times, those stocks really finally breached, and there was a change in fundamentals. So what typically happens is we discovered is prices are leading indicators, and very often fundamental numbers continue to come for 2-3 quarters before they would fall off, but prices would start reflecting that far in advance. So one of the big learnings for us was in terms of formulating an internal methodology in terms of how do we protect our profits, and one of the things we looked at was companies who were breaching their technical indicators consistently 3 or 4 times. It was once we often saw companies, say for example a Bajaj Finance, reach that indicator, bounce back and go back up sharply. So not to be caught on that. So I mean, this was some of the things that we looked at really.
And that's exactly the debate that we've also been having internally as to where is it that you choose when it comes to price versus valuation versus growth. And a lot of people have talked about the fact that, these companies have done fairly well. They've given you handsome returns. They've been great examples of compounding. But what next for a Bajaj Finance, for an HDFC Bank, for a TCS, or for that matter, even a Nestle, which has managed to beat the industry growth, 10% sales growth in the quarter gone by. It's overpassed even a Unilever, a Dabur, and all the other peers in its sector, so to speak. One wonders whether the time has come to really take some chips off the table when it comes to these creme de la creme names.
So it's always a very difficult decision to take, and as Atul was saying, selling is something which most fund managers are not great at, and you have 99 books on buying but hardly 1 book on selling. But the point I think is that some of these companies who have shown consistency, what you will see probably is sort of a time correction, but you don't really see them coming off the cliff. But I was more specific. So some of these large cap names, whether you talk of the HDFCs or the Bajaj Finances, might get into zones where they might not give you returns for some period of time, which is really the law of normalized returns starting to play into some of these stocks. I don't think there are necessarily times to sell some of those stocks, but I think more specifically when you look at the broader market and a lot of the mid cap names, what we have seen out there is that those cuts can be very sharp and deep, and you're often most people are getting into these mid-cap names, and then they'll end up making humongous amounts of money. I think the important thing is how do you protect those profits, because these so-called rich names might give you time corrections, might not perform, but they're not going to really see you erode your capital. I think this becomes more important for the broader market and the other mid-cap names.
Okay. Okay, fair enough. Of some of the names that have been moving in the broader markets, then Nitin, just want to focus on a few. I know you mentioned a couple, but what else? Let's say from the banks, would you be looking at some of the names that have been bouncing around of late? Outside of the ICICIs of the world?
So I think, look, we all realize that the next 1 year is going to be tough, and it's going to take time for the economy to come back. Now, during this period of time, it's very difficult to really come up with what other names could come under stress, because the likelihood of that happening could be very, very high. So I think it's at this point of time, we would stick to some of the larger private banks, because again, I'll take a corollary of if you go back a few years post the tech bubble crash. What we saw is that the larger tech companies had a greater possibility of withstanding intermittent shocks, so a client going away and so on and so forth. A similar example holds true for banks right now. So if you're a small bank or a mid-sized bank, if there is one account which goes bad, the impact that it can have on your profitability is far higher vis-a-vis a larger bank who can sustain some of those. And we've seen that whether it's been with the case with the HDFC banks of the world or even an ICICI bank. So I would yet continue to remain in that, because also don't forget the capacity of these banks to raise capital in these markets is higher and garner more market share, as said, vis-a-vis some of the smaller banks. So I don't think, from a bank perspective, I think it makes sense to stick to the larger names even today, because there will be growth and there will be market share gains.
Okay, let's also go across to Vivek. A lot of news in Sun Pharma today. Let's just take stock of that and also how the counter is reacting. Vivek?
Well, you're talking about Sun Pharma. Earlier in the morning, we had highlighted how, there was a fresh bout of allegations against the company. And now remember, what is it that is against the company at this point of time? Probe of cartelization price fixing in the US market. Number two, a probe against the company regarding accounting practices in India. And now a fresh bout of allegations where, one of the ex-employees has actually made two major allegations. Number one, she's actually spoken about not being given a fair chance. And the other one, more importantly, is the fact that what she is saying is that Sun Pharma has resorted to unfair marketing of its products. And what she's actually saying is that off-label promotions are being done for three very major drugs, Illumina and Absorbica as well as Yonsa. Now, remember, these three drugs are something that are in the specialty pipeline, and analysts have actually penciled in quite a bit of a significant run rate from these three drugs. However, in case the company is found guilty, the price that it could pay could be quite immense. However, we reached out to the management of Sun Pharma. They told us quite significantly that the allegations made in the lawsuit are without merit. They said that they would be vigorously defending themselves. Post that, you actually saw quite a bit of a brief recovery as far as Sun Pharma is concerned. But this is a developing story. It'll be important to watch what exactly transpires out of this particular lawsuit.
Okay, that's the word coming in on Sun Pharma, and irrespective of the management clarifications, well, the stock is definitely lifted from the lows of the day. It was way lower when it began trading today, but still in the red, about 1% or so. The other one in focus are the three major earning contenders today. That's Hindalco, Coal India as well as Britannia, and Mubina joins in to analyze all the earnings in detail. Mubina?
Well, the tough times for Hindalco are far from over. We are expecting a revenue decline to continue, 5.5% of a degrowth at 10,290 crore rupees, and the EBITDA without Utkal is down 25%. With Utkal, it's down close to 40%. Margins as well are seen compressing at 8% versus 10.1%, and the profit after tax is seen declining 64%. Now, while on a year-on-year basis there is going to be a sharp decline, on a QOQ basis still there'll be a marginal rebound or a recovery, simply because firstly the hedge contracts are favorable, secondly the Muri plant shutdown is completely behind them, and yes, copper volumes as well may pick up a tad bit, but again, lower TCRCs, lower LME prices in turn will play complete havoc on Hindalco, which unlike its subsidiaries Novelis and soon to be subsidiary Aleris will be continuing to have a tough quarter. For Coal India as well, the fate is going to be pretty much similar because, not only did we see the price hike come into the base in Q2 FY19, we also did see a decline in the top line of 11.6%. That's 11% in volume terms at 122 million ton. And then the EBITDA as well fell by about 26.3% at 3,180 crore rupees. Margins as well are seen compressing. Profit after tax is down by almost 19%. Now, do remember the problematic figure here is the fact that the better realization, grade of coal, or rather the method of sale for coal, that's e-auction, the mix of e-auction has declined. So that in turn will hurt blended realizations. FSA realizations are still seen stable, but blended realizations will be a tad bit lower. Plus, you have that 11% drop in volume. So yeah, things are not looking good for Coal India as well, as is the case for a Hindalco. Well, a top line growth of 5% is what we're expecting from Britannia in the second quarter. Again, you've got to attribute it to the entire weakness in the consumer sentiment and plus those very scathing statements from Varun Berry on the consumer sentiment. EBITDA has seen higher just by 3.1%, so margins will just about be at 15.5%, close to what it was in the corresponding quarter. But again, thanks to the tax credits, there will be a boost on the bottom line, seen higher by 26.5%. The most important figure is, of course, the volume growth number, which unfortunately Britannia does not explicitly say, but 4 to 5% is what we are seeing the volume growth at. Margins will stay under pressure because we have seen inflationary, trends come in from wheat, milk, sugar, etc. But I think it's also going to be interesting to see what they say about the SKUs that are being sold and the rural growth commentary as well.
Okay, let's also go across to Vivek on Amaraja numbers, which have obviously been met with cheer, and they've in fact kept up to their guidance as well. Vivek, talk us through the numbers.
Well, absolutely. Amara Raja definitely, even in today's extremely volatile market, has held up quite steady. The main reason for that is that the company's earnings were extremely strong and resilient. Although the revenues are down 3%, if you're looking deeply into the numbers, auto OEM demand was quite weak. However, the replacement demand was something that was quite strong, and that has helped aid the top line. Now, on the back of lower lead prices, as well as a better product mix, as well as the revenue mix, margins have gone up quite higher, almost to 350 basis point jump in margins, and profitability on the back of that has almost doubled on a year-on-year basis. Now, what has actually happened is that this is a much better result compared to its peers, multi-quarter high EBITDA, and also if you're talking about the profitability and guidance, the management at this point of time has actually maintained its guidance, while analysts on the street were quite worried that they would be unable to do so. At this point of time, extremely good set of numbers and whole host of EPS upgrades coming in as far as Amara Raja is concerned.
Okay, so that's Amaraja for you as well. We've got other numbers too that have stood out, still watching out for a few as we just went through those previews as well today. Okay, so, Nitin, what else should we, talk about in terms of earnings specifically, from the mid-cap basket, anything that surprised you that you're looking at positively?
I think if you look across the basket, the cement companies actually showed a decent set of numbers. When we look at the cement basket, we saw a very healthy growth in their operating profit numbers. And again, as I said, I'm not talking of PAT numbers because they were an anomaly. The pharma basket, which has been, has been an underperformer for a long time, actually came up with a decent set of numbers. In fact, it could get distorted, but among the pharma companies, we saw a 13% sales growth and a 40% operating profit growth. So these were some of the baskets which surprised, and of course, then you had the services entities, which like as I was mentioned earlier, the hospital companies, the exhibition, which is basically the theater companies, which did well during the quarter. So, and of course, the gas companies have delivered some excellent set of numbers. So I think these are certain businesses which have visibility, which are relatively non-cyclical also, and do not really trade at lofty multiples.
Okay. All right, fair enough. So that's the verdict coming in from Nitin on some of the earnings that we've had. Let's also get you some more of our new series, the 18-hour time machine. In fact, The Wall Street veterans have been sharing what they do differently. Could they have been younger again or gone back in time? They've taken a journey, on what stocks or shares they missed out on, what perhaps, what strategy, what move they may have missed out on at one point, and they share those stories with us. Listen into this one.
I think one of the biggest mistakes I would say is investing in some of these infra companies sometime in 2006, 2007. This whole concept of sum of parts was very prevalent there, and the markets and myself would have given very aggressive valuations, which sort of corrected post the Lehman crisis, and that was a hard learning. So I guess that would be one of my biggest mistakes.
Just want to mark one more name, BPCL. While we've been talking about as to how BPCL has been a standout performer in the last 6 months, last 3 months, or even for that matter, last 1 year. And today is no different. What a huge spike up you're seeing, a solid 3% move. In fact, some of these disinvestment candidates are back in the fray. Concor as well is at the high point of the day, a solid 2.25% move coming in there as well. And as I see on my screen, most of these PSU names are holding out quite smartly. Nitin, is that a space which is looking attractive? Because clearly seems that disinvestment is high on the government's agenda next.
Well, I mean, clearly these stocks are going to remain buoyant on hopes of the valuations as far as disinvestment is concerned. BPCL has already seen a substantial run-up, and its pricing has got nothing to do with what its immediate fundamentals are vis-a-vis what its valuation would be. I think we've seen a substantial run-up in some of these stocks, and we would rather stay with, rather than trying to play an event-driven strategy, which we do not know how they will pan out or when they will pan out. We would rather stick to, being with stocks where we see numbers and earnings growth.
All right, Nitin, thanks so much for joining us. Let's take a very quick break on that note. A lot of other numbers to talk you through, as well as an update on the political scenario in Maharashtra. Back in a moment.
Back with closing trades. While it's a very sedate market today, all eyes are clearly on the Maharashtra politics. That's keeping everyone busy, as the big question remains, who will stake claim on the Chief Minister's throne? Tamanna Inamdar, my colleague, joins in with the latest twists and turns on this. Tamanna, almost turning out to be a Mahayuddh.
Absolutely, Aisha, that's the apt term for it, and one in which the outcome is still a bit of a suspense. Now, there's been a flurry of meetings over the last couple of hours. Shiv Sena Chief Uddhav Thackeray has met NCP Supremo Sharad Pawar. There is a key meet that is going to take place at 4 this afternoon in Delhi, where Sonia Gandhi, the Congress interim president, will meet all the Maharashtra leaders who have flown down to see what they want to do. But the wheels seem to be in motion. All of this is working towards a 7:30 deadline of sorts that the governor of the state has given the Shiv Sena to come and prove whether they have the numbers or stake claim to government. The Shiv Sena trying to stitch up and dot the I's, cross the T's for what a final alliance will look like. But is this all going to be smooth and easy? Absolutely not, because now what's at stake? Number one, who will be the chief minister? Will the Shiv Sena get the full 5 terms, or will they have to come into a negotiation with the NCP and the Congress? There are some murmurs now that Uddhav Thackeray himself could take on the chief minister's chair, but don't put your bets on anything right now. The NCP and Congress will also want a common minimum program, which they'll want the Shiv Sena to sign off on. That's the only way they can explain to their voters why they have chosen what some are calling an unholy alliance. So there's many a slip between the cup and the lip. We'll have to wait and see whether this really unexpected combination of the NCP Congress with the Shiv Sena can actually fructify over the next few hours.
Absolutely. But it seems, Tamanna, for NCP, this is the best way to go.
Absolutely, Aisha. I mean, they perform better than expected, and a lot of that was believed to be because of Sharad Pawar's last-minute ditch. Let's just jog back about 2-3 weeks ago when there was this cloud of an enforcement directorate case hanging over Sharad Pawar, Praful Patel, and many top NCP leaders. They have definitely bounced back from there. For the NCP, it's a win-win either way. Even if the BJP and the Shiv Sena had somehow, decided to form a government, the NCP for the first time in its history would be the major opposition party in Maharashtra over the Congress. So they were anyway on a better footing than before. In this case, it's absolutely like an unplanned for opportunity which they are keen to grab. But they will have to do it in a calibrated way. It will have to be a give and take. The NCP will also make its demands, and we'll have to see if the Shiv Sena will now accommodate them.
All right, thanks for that, Tamanna. Waiting to see how this pans out. It's definitely going to keep everyone on their toes, Maharashtra and the seat there. Who will it finally go to, and will they actually manage to find that solution? All right, back to markets for now. It's steady, and it's really all about those individual stocks. Let's get some more strategies going for you with our technical experts. CK, what else are you tracking this afternoon?
Well, I think there has been some sudden sense of life which has come into BHEL. So I would be looking at that as a stock to buy in, and currently it's at about 56.5. I think there is potential for it to retest its recent high around 61, 62. So with that in mind, recommending a buy, a stop loss to be placed at 54. A second stock from a similar industry line would be Siemens, where good trends are ensued, and after some consolidation, fresh upside move being signaled. Buy Siemens current levels, about a 15-point stop loss from your entry price, and we can keep a target at about 1690 in our midst for as a potential level.
Okay. Rajesh, what about you?
Yeah, my first stock is from automobile pack is Escort. If you look at the structure, stock is trading above all its important moving average, and if you look at the structure in last few trading session, we have seen a small consolidation action has been witnessed in the stock prices, and in the today's trade around stock has gained around 4.6% long addition on the derivative side. And looking at the structure, I feel that stock can move further higher from the current level towards 680, even higher from 680 level. So one can buy with stop loss of 653 for upside target of 680 and 690. Another stock is again I'm also giving buy on the Siemens, and looking at the structure, stock has managed to give the multi-month breakout on the monthly chart, and looking at the structure, I feel that stock can further rally from the current level towards 1715, and even on the derivative side, stock has gained around 4.6% kind of open interest throughout the session. So looking at the data as well as the chart structure, I feel that stock can rally further from the current level. One can keep stop loss of 1655 for upside target of 1715.
Mandar, let's bring you in as well and get a look at some of the strategies you're tracking this afternoon.
Yeah, I've got two stocks, both are banks. See, first one is RBL Bank. RBL Bank had a resistance at around those levels of 320 and 325. And this level in the past has acted as a support, also acted as the resistance in the last 3 to 4 months. And today in the intraday trade, we find that the stock is comfortably trading above this resistance. So this is the first sign of strength that the stock is showing. If the stock sustains above 325, then we can expect a move to levels of 390 to 420 in the next few weeks. So therefore, I have a positional buy in RBL Bank. Stop loss for the trade will be 315, and on the upside 390 to 420 is the target. The second stock is ICICI Bank. This also is an interesting price formation. 460 was an important level for the stock. Earlier this level was acting as a resistance. Later on, as it broke past this level in the month of October, it came back to test that level as a support, and again has moved up, managed to make a new high. So that is interesting formation. It clearly shows us that the stock is ready to stay in that uptrend that it has been for the last few months. So therefore, a buy in ICICI Bank, the stop loss for this trade will be 455. This again is a positional trade, and in the next few weeks, I expect the stock to trade around 580 to 600.
All right. Okay. Let's, in fact, take a break on that note. We've got lots of strategies that we'll continue to track. We're counting down to close, about half an hour to go. Back with more in just a moment.